The Santa Claus rally, also known as the year-end rally, is a phenomenon that occurs in the stock market, typically around the end of the year. It is characterized by a sudden and significant increase in stock prices, often attributed to holiday cheer and increased consumer spending. The Santa Claus rally is important for investors to monitor because it can provide insight into the market's performance and serve as a potential indicator of future trends. The origins of the Santa Claus rally are somewhat unclear, but it is believed to have first been identified in the 1960s by Yale Hirsch, editor of the Stock Trader's Almanac. Hirsch noticed that stock prices tended to rise in the final week of December and the first 2 trading days of January. This trend became known as the Santa Claus rally. There are a number of theories as to why the Santa Claus rally occurs. One theory is that the holiday season is a time of increased consumer spending, which can lead to increased demand for goods and services and, in turn, boost the stock market. Another theory is that the Santa Claus rally is fueled by a sense of optimism and cheer during the holiday season, which can lead to increased investor confidence and higher stock prices. Regardless of the exact reason for the Santa Claus rally, it is important for investors to monitor it because it can provide insight into the market's performance and serve as a potential indicator of future trends. For example, a strong Santa Claus rally may be a sign of investor optimism and could be a good indicator that the market is likely to perform well in the coming year. On the other hand, a weak or non-existent Santa Claus rally may be a sign of investor caution or market uncertainty, which could be a red flag for investors. It is also worth noting that the Santa Claus rally is not a sure thing and that the stock market is subject to a wide range of factors that can affect its performance, including economic conditions, political events, and global trends. As such, it is important for investors to be cautious and to consider a variety of factors when making investment decisions, rather than relying solely on the Santa Claus rally as a predictor of future market performance. In addition to monitoring the Santa Claus rally, there are a number of other things that investors can do to stay informed about market trends and make informed investment decisions. Some of these strategies include keeping an eye on economic indicators. Economic indicators, such as GDP, unemployment rates, and inflation, can provide insight into the overall health of the economy and can be useful for making investment decisions. Diversifying your portfolio. Diversifying your portfolio can help to minimize risk by spreading your investments across a variety of different asset classes, such as stocks, bonds, and real estate. Monitoring company news and performance. Keeping track of company news and performance can help you to make informed decisions about individual stocks or sectors. Seeking professional advice. If you are new to investing or uncertain about how to make the best investment decisions, seeking professional advice from a financial advisor or investment professional can be a good way to get the guidance you need. Despite its potential importance, it is important to note that the Santa Claus rally is not a sure thing. Some years, the market may not experience a significant increase in stock prices during the holiday season. Additionally, it is important to remember that the stock market is subject to many factors that can affect its performance, including economic conditions, political events, and global trends. As such, it is important for investors to be cautious and to carefully consider their investment decisions, regardless of whether or not the market is experiencing a Santa Claus rally. Overall, the Santa Claus rally is a phenomenon that occurs in the stock market around the end of the year and is characterized by a sudden and significant increase in stock prices. It is important for investors to monitor because it can provide insight into the market's performance and serve as a potential indicator of future trends. However, it is important to remember that the Santa Claus rally is not a sure thing and that the stock market is subject to a wide range of factors that can affect its performance. In addition to monitoring the Santa Claus rally, investors can also stay informed by keeping an eye on economic indicators and diversifying their portfolio. Use code BLOG to receive 25% on your next purchase.